The AI mania is back, and it's taken us to new all-time highs. Thanks to Mark Zuckerberg's massive investment in the fantasy land, chipmakers are soaring, and it was exactly the catalyst we needed to break us out of a long-standing balance in the S&P 500. It's been a little while, so let's look through all of the supporting evidence charts today and build a logical game plan for the week's worth of trade. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure, solid green-bodied bar with a meaningful lower wick, and of course that would imply that the buyers really stepped up near the lows of the weekly range and they were able to close near the highs of the weekly range. There's virtually no upper wick on the weekly bar, and we also know that this is a new all-time high close, so incredibly bullish in terms of structure. If we think about location on the bar-to-bar count, certainly a nuanced higher low as well as a higher high. Buyers go 2 for 2 on our weekly count. If we're thinking about trend, the trend is clearly up, producing a brand new higher high in the overall sequence coming from the October low. If there was ever an opportunity for a pullback, it would have been right here, right? Firstly, we had an inverted hammer on the weekly. It was a change in character. We had 8 preceding green weeks, certainly got a 9th green week, but with a larger upper wick. And then we finally saw a solid red-bodied bar, lower high and lower low on the bar-to-bar count. And that was it. From there, we've seen an immediate reversal back up towards this new all-time high, and we never got anywhere close to the retest level back here at 459 and the top of the 2-week balance, which broke out when we had the FOMC catalyst. So it begs the question, are stronger sellers getting involved in this market? The answer is simply no. And I mean, you could look at the chart and you could just say, we're at all-time highs. Of course, there are no stronger sellers getting involved. But even when we did get a pullback, there was no attempt to get a stronger pullback to a structurally relevant area here in the S&P weekly. So if there is going to be a reversal, which as of right now, the structure and location would not suggest that, but the first place I would be thinking about a weekly higher low is at the top of this as a weekly balance. And don't get me wrong, this is still a structurally significant place to be thinking about. 459 is just not in play for the coming week's worth of trade. If we were to violate the bottom end of this pullback from over here, the bottom of this weekly balance, we will certainly have fallen into a daily downtrend ahead of that, and we would let you know on the smaller time frames first. So for that reason, it doesn't really make sense to be talking about pullback levels from a Fibonacci perspective. As we can see, your 38.2 is still underneath that prior pivot high. So that's not really good. That's not helpful for this week. Same thing with the anchored view apps here on the weekly. We're just going to check in on these things because we haven't looked at these charts in quite some time. We took a hiatus, right? So that's still underneath. No good there. The one interesting thing that we can say is if we take a look at the volume profile here on the weekly, let's auto zoom that. We know, and we can talk until we're blue in the face about the 459 level, right? Prior resistance, structural shelf in terms of volume as well. But this is the one that really captures my attention possibly for the coming week's worth of trade. You have the prior flat top, the green inverted hammer upper wick after the previous all-time high was set. It's nice to be able to say previous all-time high now. And it's also a high volume node. And you can see that that is where the buyers stepped up in the lower wick of last week's bar. But if we were to get a red weekly pullback, is that a higher low above the red pullback from back here? The answer is absolutely. So 470 still makes a lot of sense on this weekly time frame chart. Instead of talking about pullbacks, we're going to start talking about these extensions a little bit more often as we head into blue sky territories. We talked about this when we wrapped up the month of December, but the cup and handle on the higher time frame, like the monthly or even just here on the weekly, if you want to look at it from this point of view, if you extend that all the way up to the measured move target, you're talking about 520. Right? 520. Now, we're not talking about getting 520 in the coming week's worth of trade next week or the week after that, but over time, the suggestion is that, yes, based on the pattern, there is more room to run in the upward direction. And not for nothing, this is like, I would take this pattern with a grain of salt just because of it's been 9 weeks in a row vertical, right? But if we come in from the low and then we come to the top of the balance, pull back to the bottom end of the weekly balance, right? Just a very classic bull flag extension here. It's actually above the cup and handle that we just measured out with more than a year's worth of base behind it. So I would certainly trust the 520 with a year's worth of basing prior, as opposed to the 9-week rally and now starting to break into all-time highs again. But 532. So once again, what's the illustration? Is there room to run in the upward direction? The answer is absolutely. And the answer to the question, are stronger sellers getting involved, is absolutely not. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's 488.26, and that of course implies a new higher high, a new all-time high. If we're contained by the lower bound, the number's 476.60, and that implies a higher low. So expected move is more bullish than bearish. Obviously, our trend is in the upward direction. We have lows, higher lows, highs, and we just broke out to a brand new all-time high, which of course, by nature of being so, is a higher high in the trend sequence. So even if we were to pull back, we know that we can afford a daily higher low and still maintain an uptrend here. The first place I would be thinking about for that higher low would just be a pullback to test your previous all-time high. If you want to be precise to the penny, it's 479.98. For those who like round numbers, 480 will do just fine. Anything deeper than that, your big line in the sand this upcoming week is going to be right here, the retest of the top of the daily balance area from over here. That number is 477.50. We'll see some confluence with 477.50 on the hourly time frame chart in just a moment as well. That would produce a beautiful higher low, and from there, we're looking back into blue sky territories. If you pull back first and we don't just get straight up trend continuation, of course, this all-time high that was set on Friday will have to act as your first target. But beyond that, you're going to start looking at a range double, right? So the range double would take this balance range and it would stack it directly on top. And we're looking at roughly 486 as a measured move target there. Anything beyond that, you could start thinking about the upper edge of the weekly expected move, 488.25. And again, this is just a suggestion from the options market. It doesn't mean that we have to go there and stop, but it's one potential area as we navigate uncharted territories, basically to say, okay, it would be reasonable if the market slows down around this area based on the forecast of the options market, right? So that's really what we're watching for. And the key line in the sand here on the daily chart is once again 477.50. A couple of nuances that I do want to point out here is that we had a very gappy week, right? We gapped down on the Wednesday session, we gapped up on Thursday and Friday, and it's very important to note that all of the gaps have been filled here. And it's twofold in terms of its importance, right? Not only has the structure been repaired underneath us, so there is no thin structure, there's no gaps to go back down and fill as we move into the future, but the second and possibly more important piece of this is that the sellers had an attempt. They tested lower, and then we closed at the highs of Thursday's session on Friday, right? There was a test lower, then we closed at the highs of that Friday session. So again, going back to the question we asked on the weekly time frame chart, are stronger sellers getting involved in this market? The answer is absolutely not. And again, it's not just like, let's continue to extrapolate this. Let's really dive in today. What would it have meant if stronger sellers got involved here, right? That, of course, would have meant a daily lower high, back down in the midpoint of this as a balance range. Any reattempts at the bottom end of the range, the door would have been open for a move in the downward direction. Even on Friday's session, right? If we were to get some sort of pullback more meaningfully off of this and close the week inside the midpoint of the range, we wouldn't have had a range break. It's still possible that the market could have remained neutral inside of the balance range. Obviously, the breakout speaks for itself, and the buyers have much more of an edge here on the daily time frame as compared to not. Let's take a brief glance at our daily anchored view app spread just because we're going full gamut on today's update. First one back in 2 weeks. If you didn't know, we had to deal with the quote sickness, not just like the cold and flu, but the sickness, if you know what I'm saying. And we're finally up and over that. The energy is high. The recovery arc is going to be beautiful. As we know on the weekly chart, we're above all of these anchored view apps over here. But if we do start paying attention from the orange anchored view app, the most recent breakout of this balance range from back here, let's take a closer look. Over time, so we've got an anchored view up to the top of the range, the bottom of the range. We know that the orange one is the breakout from the previous range. As we move forward in time, those will slowly, maybe not this week, but certainly the week after, as long as we stay over the top of the daily balance over here, will provide confluence with 477.50 over time. And that, of course, is another bullish reason to be thinking about that level as a potential line in the sand. Let's take a look at the hourly time frame chart here and see what else we can learn, dissect this price action even further, right? So obviously, we're in an hourly uptrend. It really speaks for itself. You can see your daily higher low here. You can see your daily higher high here. And along the way, you can even say that we have lows, higher lows, and it's been a near vertical move ever since that higher low was put in on the Thursday afternoon session. But what is so important about the Thursday afternoon session is that we did not find that lower high underneath 473.75. If you're watching intraday on Thursday, there was a massive threat with weak internals that there was an opportunity for a lower high here at 473.75. And I know we've been absent for 2 weeks, but some of the last videos I had left you with as we were moving into the beginning of the new year was really underscoring the importance of this level right here, 473.75. Why? Sellers were emboldened, structurally relevant, right? So we know that this level held the key as we were walking forward. To see Thursday's rally blast through that and to close strong in this upper balance over here from the Friday session before, in the previous week, right? That was a pretty bullish indication, and in my eyes, was really setting the tone for what happened on Friday. And again, on Friday, as we talked about on the daily chart, with this gap up, as we faded to close the gap, there's nothing saying that we couldn't have stayed inside of the balance range and faded off here. I mean, sure, we had the AI catalyst, and that certainly helped push things in the upward direction, but for the most part, very bullish. This breakout of the range has been bullish. The structure has been repaired beautifully underneath us. We don't have any gaps that are outstanding or left unfilled. So, as we know, the main name of the game is looking for pullbacks here. Hold your prior all-time high, and any pullbacks here are also extremely bullish, holding the top of the balance range on the daily chart. Let's take a look through the lens of the Fibonacci, because in my eyes, this is again just beautiful confluence. Your 38.2 is right there at the 477.50, so that reinforces the idea of that being the line in the sand. We could also take a look through the lens of our intraday anchored VWAPs, and what you'll notice is this is very similar to the one that we anchored to the top of the range and the bottom end of the range, but over time, they will slowly start to provide these maybe a little bit more rapidly, especially this one off of the Wednesday low, will provide confluence around that 477.50. One thing that you can pay attention to early on in the week, if we open up on the Monday session and there's immediately a pullback, notice that your anchored VWAP to the Friday session is loosely, as of the close, confluence with your prior all-time high, 480, as a nice round number. That is one possibility. Let's talk about the bearish side of this coin. We've been very bullish on the chart so far, and I think rightfully so after examining all of the evidence in front of us, but let's say there's a stronger reversal. The biggest threat on the daily time frame chart, I know that we're still on the hourly, but the biggest threat is that this turns into a look above and fail. Any lower highs underneath 477.50 cement that look above and fail, and as we know, the target is always the opposing end of the balance. That would bring us back down towards 468.50. From there, we would definitely be in a daily downtrend, so don't you worry about the weekly pullback we just discussed, right? We'll fall into a daily downtrend well in advance of breaking down through the bottom end of the weekly balance. If we were to take this out, 10 points lower brings us to the key weekly pullback level at 459. Does this seem like a high probability outcome to me into the coming weeks worth of trade? The answer currently is no, based on all of the evidence that we're about to walk through. Let's kick it off with our market internals. So here they are in their full glory. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner on how to set this one up. Overall, in terms of volume outflows, very substantial on Tuesday and Wednesday. Tuesday and Wednesday advanced decline line also very close to our trend lower zone, and the cumulative build always speaks for itself because this does not matter in relationship to the previous day's close. So this could have been skewed on the Wednesday session with the big gap down, could have been skewed here on the Wednesday session with the big gap down. Not the case for the cumulative build. So if we had stronger sellers entering this market, and don't get me wrong, the solid volume outflows might have been a first suggestion of that, why were they unable to keep prices suppressed into the end of this week? To me, it would start to suggest that this is much more of just profit taking on the Tuesday and Wednesday sessions over here. But let's continue down the rabbit hole. On Friday, we saw a big breakout to a new all-time high. Did we get substantial volume inflows? The answer is no. Okay, that's a bit of a head scratcher. What about the advanced decline line? Not even close to trend higher zone, didn't even dip a toe into it at all. And what about the cumulative build? Sure, it built out to a nice solid read, plus 5,223 as of the close, and that is substantial, but took a little while for it to ultimately get there. So, begs the question, are you looking for straight up continuation into the early stages of this coming week? To me, at the exchange level, there is a little bit of a divergence. It wouldn't be unreasonable that this speaks to sort of concentrated breadth, which makes total sense based on the news catalyst which sent the market higher in the first place. If you see pullbacks out of your core list of companies, the Magnificent Seven, if you will, it's totally reasonable that your market pulls back based on the internals and at the exchange level, not full-blown participation to the upside on that Friday session. So pullback first, not strong sellers, more profit taking than anything else. And here's the market profile as Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, what's happening with the value areas and point of control. Let's cover it all since we missed out on the midweek market update. Let's get you back up to speed with our profiles here. So we're just highlighting the value areas. Obviously, you can see that they marched higher into the end of the week, as did the points of control. One other interesting nuance that I find here is that on that Wednesday session, when we did see substantial volume outflows from from this market. There was really not a lot of price commitment down at the lows of the session there. You can see that the value area was much higher in the individual profile. The purple line, or blue, depending on your screen, always represent halfback. I would say that the majority of the value was in the upper 50% of that individual range, as obviously was the point of control. You'll notice that we had a low point of control and value on the Thursday session. And again, this speaks to the opportunity that was there for a lower high into that afternoon. And it just did not take place. You can see we get the M period spike, and this is on the heels of repairing the poor high from what we had on Wednesday, right? So Thursday repairs that, produces a spike, and you can see that we open inside, or just above, just above on a small gap up, that's right, just above the top of the spike. We test into the spike and immediately start taking off outside of it. So are these buyers validated from even the worst possible location on Thursday? The answer is absolutely yes. And you can see that the point of control does migrate higher. So again, if we're thinking about pullback first, is it better to have a value area and point of control higher or lower? A little bit of a rhetorical question. Obviously, it's going to be much easier for these folks at the worst possible trade location. We know that there's plenty of them because that's where the point of control is. It's easier for this to turn into overhead supply and yield a pullback as it would be compared to a value area and point of control that was lower. So again, does this marry up with the thesis we sort of outlined over in the market internals? To me, the answer is yes. A place that I would start thinking about in our futures for a pullback to unfold would be underneath 4860. Underneath 4860, there's a small string of I period single prints. If I zoom in on this, we might be able to see it. Yeah, there we go. Look at your I period single prints. If we start to break down underneath that, again, 4860, did I say 47? I meant 4860. If we take out 4860, that's where a deeper pullback could unfold. And once again, you're looking at your prior all-time high in the SPY cash market, and then you're looking at the top of the daily balance range on the SPY as well, 477.50. Switching gears to the NASDAQ 100, what do we see out of the QQQ weekly time frame chart structurally and location-wise? Very similar to the S&P 500. However, the lower wick on a relative basis compared to the candle body is a little bit smaller. So it's really twofold. Number one, you could just say that, okay, the sellers did not have as much momentum earlier on in the week. Or number two, the candle body is larger because the buyers had much more momentum up and over the opening print for more range expansion in the upward direction. Regardless, we did close at the highs of the weekly range, making a new all-time high as well. Ties directly into candle location, obviously bar to bar count, higher low, as well as a higher high. And I would point out that the magnitude of this higher low and higher high are much greater than what we saw over in the S&P 500. And that should make sense considering that a majority of the returns were driven by the Magnificent Seven and the tech cohort in general. So in terms of trend, we're definitely in an uptrend on the weekly, obviously new all-time high, but lows, higher lows, and along the ways, highs, and higher highs. So pulling back, we can certainly afford a higher low. And just like the S&P, a lot of these concepts will have some overlap here, right? If we think about a deeper pullback, it should have happened back here. Inverted hammer changes the tone, solid red-bodied bar, lower high and lower low, even a weekly gap mixed in there as well. Simply, stronger sellers were unable to continue to move prices in the downward direction for a retest of your previous pivot top from over here and the support from over here. But let's take one step behind the curtain, one side step with me. What do we know about market structure, right? If we're in a bullish sequence, we want to see prior resistance act as newfound support. So did we really want to go down to the bottom end of this range over here? Probably not. The fact that the prior resistance here did turn into support at the lows of the red-bodied bar, once again, is another piece of supporting evidence that we do not have stronger sellers entering this market, and instead, structure is holding up on the bullish side of the market. So with that said, if we were to get a pullback in the coming weeks worth of trade, which once again, there is no suggestion based on the solid green bodied bar, everything that we've just talked about so far, if we were to get a pullback, the top of the weekly balance range here would be the first watch, much closer to 410. We'll get precise with that level on the daily chart in just a moment. 410, and then the lows of the weekly range in here, closer to 403. Again, we'll get the precise number for you on the daily chart. But the reason behind that is exactly like the reason we have in the S&P. If we bring out the Fibonacci's from the lows up to the highs, not really in play. If we bring out our anchored view apps on the QQQ weekly, not really in play. But if we bring out our volume profile on the QQQ weekly, and let's auto zoom this real quick, we'll notice that, we already made a new all-time high back here. So we don't have that volume shelf like what we have in the S&P 500. But if you wanted to use the previous all-time high in this small little volume node right here, it's just ever so slightly sticking out. It's the lows of last week's session. So once again, 403 makes the most sense here on the higher time frame charts if we're using the volume profile as a potential support underneath the top of the balance range. Just like on the SPY daily, we'll talk about look above and fail, and it's likely a larger concern concern if we move underneath that 410.25-ish level on the retest. I wouldn't want to see 403, but technically speaking on the weekly chart, yes, you could produce a higher low there. Just like in the S&P, we should start focusing on some projected measured moves from our larger patterns that are in force. Here's your cup and handle, and I'm also just going to bring this one in at the same exact time, and we'll talk about them in unison. Obviously, your cup and handle looks something like this. On your QQQ, the breakout from that one is actually the upper target here. It's inverse to the S&P. That's 476, roughly 477 if you want to round up. And then the measured move from this to the pullback low of the weekly balance is here at 465, we'll call it, for round number 6. So overall, the suggestion is the same. Do we have to go here this week, next week, or the week after that? The answer is absolutely not. But we do have upper targets to be thinking about. The patterns would suggest that there is further room to run in the upward direction. And as we've examined, as we were zoomed in more closely, we also do not have stronger sellers on the higher time frames for all of the reasons we've just discussed. On the daily time frame chart, let's first take a look at the expected move. If we're contained by the upper bound, the number is 428.57, and that of course implies a higher high and a new all-time high. If we're contained by the lower bound, the number is at 413.81. It's hidden in there with a confluence around a number of other levels, but that of course represents a higher low. So expected move is in force as a bullish phenomenon here, just like the S&P 500. In terms of daily trend, this is a very important nuance and distinction that we need to make. Here is a higher low and here is a higher high. We are absolutely in an uptrend. Of course, we just produced a new all-time high. However, the threat prior to Thursday was very real. We had a high and a possible lower high. We had a low and a lower low. I don't know about you, but it looks like the beginnings of a downtrend. So it really underscores the importance of the breakout on Thursday and Friday, resuming our daily uptrend. So for that reason, instead of having a line in the sand here at the top edge of the daily balance range, it's actually going to be here at the 3 equal highs, which had struggled before this breakout on Thursday and Friday. So we know that we have a higher high. We know we can afford a higher low pullback. That's the name of the game when we're trying to manage uptrends, right? So if we do get a pullback, gap fill reversal, lower edge of the weekly expected move, top of the balance from the 2 equal highs 1 and 2. Beautiful. Line in the sand there is at 412.75, but that's just for this cluster. Line in the sand just for this cluster. Line in the sand on the daily time frame chart, as we just pointed out, is technically a higher low anywhere over 410.25. If you get this drift lower, yes, there is the threat of a lower high underneath, but I'm going to give you a hypothetical here, which is going to help you navigate that potential situation. This is all hypothetical, right? Let's say we see a pullback that is deep, that takes out 412.75, and we get here and we start to find buyers. If the sellers on the internals are less aggressive than the buyers are in the internals as this turnaround is happening, I would not be concerned about a lower high here. If the sellers are more aggressive on the breakdown / pullback versus the buyers who start to step up off of 410.25 potentially, then I would be concerned about the lower high retest at 412.75. Right? So that's how you use context to help give you, confidence or a lack of confidence around any particular level. And once again, totally hypothetical, but the levels still remain very substantial, right? 412.75, 410.25 as a line in the sand on the daily. Let's go LIS here for your line in the sand on the daily. All right, what about moves in the upward direction? What if we just get straight up continuation? Really, the upper edge of the weekly expected move is the target for 28.50s, not only from the options market suggestion, but if we're thinking about this as a pie in the sky inverted head and shoulders, I know it's not happening at the bottom in a trend reversal, but technically, you take from the head to the neckline, you stack that on the neckline going forward. It's basically a perfect measured move towards the upper edge of the expected move at 428.50. So that is in play as your upper target this week. What else can we point out here? There are unfilled gaps in comparison to the S&P, which has closed all of the gaps. So does that mean that we have sellers in the Qs? No. Like, let's not get it twisted. Sure, we don't have that clean gap fill reversal phenomenon on Thursday and Friday, but just tell yourself the story, right? We still got to test lower, and we were unable, so it's actually even more bullish because the sellers were unable to close that gap, the thin structure, and we still closed at the highs of Thursday's session. Same thing on Friday. Small, little test lower on that tiny little lower wick on the open, and where did we close? Near the highs of Friday's session. So sellers did not do their job and close this gap. They did not do their job and close this gap. So for that reason, we have stronger buyers. We do not have stronger sellers. However, the structure is still unrepaired underneath us. So if we were to get a pullback, this starts to act as a target. If we go further than that, 410.25, if we slip it, this is going to act as a target and a potential range to trade for. It doesn't mean that the market needs to go here. The market does not need to go here, but it does set up easier than not risk reward to manage around those potential levels. All right. So let's take out the anchored view apps and go through the same thorough investigation as we did in the S&P. We know that all all of these are the weekly ones. We're not as concerned, but the orange one and onward, slowly, confluence with that 410.25, reinforcing it as a line in the sand. Good to go on the daily time frame chart. I think we're all on the same page. Higher low pullbacks are the name of the game, or straight up continuation. This makes sense from a measured move perspective as well as the options market suggestion. Let's take a look at the hourly time frame chart for the QQQ NASDAQ 100. And it's the same concept here. Definitely in an uptrend. There's not as much to read into over here. We don't have to look at that Thursday lower high opportunity. It was actually a higher low over the top of the three equal highs 1, 2, and 3. Then from there, we're off to the races on the breakout over that, right? So all good on this point of view. I don't really think that we need to dive into any of the nuance and forensics that we did in the S&P, but we'll come in with our Fibonacci's here. The 38.2 is right around that gap fill area. So for the most part, this as a zone is what we're really interested in. And for the folks who are maybe newer to the channel, what we mean by that is if we start coming down, and let's say that we find some sort of double bottom, but it's a lower low double bottom, it's not as scary as long as we're over that line in the sand, right? That 412.75. If we slip the 412.75, yeah, different story. Now we're like, okay, let's be a little bit more cautious around here. However, treating this as a zone, like a reversal pattern can happen in this zone. Could be a double bottom, higher low double bottom, could be an inverted head and shoulders around this zone where the right shoulder's above the gap and the head's underneath. XYZ, you get the point. We're treating this as a zone for our potential pullback. And as we know, this is actually quite nice. The 61.8 from a Fibonacci perspective is always a line in the sand. Around the channel, if you've been tuning in for a while, you know that we say as you start to move underneath a 61.8, the odds dramatically increase for a 100% reversal, meaning all the way back down here towards that 404.25. So where's your 61.8? Where's that line in the sand? 410.25. Good to go from that point of view. Let's quickly throw on the anchored view apps intraday. I don't really think we'll learn much new here. Yep, we're getting confluence currently with this. We're getting confluence around this zone from the anchored view app off of the low from back here. This anchored view app will slowly also provide confluence around 410.25 as the week wears on. And if we need something high and tight on the first Monday quick snappy pullback, I would watch this anchored view app from the Friday breakout to your new all-time high. Currently, it's trading around 418.32. That is one potential watch. Let's take a look at the market internals for the NASDAQ side of things. And what we'll notice here is that we didn't actually have as strong outflows on the Tuesday and Wednesday session. We did have an even more bearish advanced decline line. The cumulative build was bearish as well, but volume-wise, we didn't suffer the same fate as the S&P. Now, on Friday, we also didn't have substantial volume inflows. We did not get into trend higher zone, and the cumulative build is kind of lackluster out of the NASDAQ. So again, this speaks to concentration in the Magnificent Seven. I would be thinking that it's very likely we could see a pullback first if the Magnificent Seven start pulling back early on Monday. It's likely going to drive a move down first, and we know that we're not panicking into that down move. We're not selling into that aggressively. We're waiting for it to come into the anchored view app. We're going to watch and see if we can find a higher low. If we don't, then maybe there's a short setup to get us into this next zone. But when and if we get here, you bet your bottom dollar we're putting our thinking cap on and saying, can we find the reversal? Can we find the head and shoulders that we were just talking about? Inverted head and shoulders, right? The strongest sell side indication for this market would be a complete collapse on the internals front. So everything blood red here early on in the week. Again, stronger sellers here. We make that move towards 410.25. We see a little bit of a relief rally, and there's no buyers to be found on the relief rally. Again, this is that same hypothetical we just talked about on the daily. So blood red internals here, weak buyers on the rebound. Lower high sets up an H pattern. I would only be more bearish on the higher time frames like the daily, saying that we've lost our attempt at a daily reversal back in the upward direction. We're losing our hourly uptrend if we get this H pattern here and slip underneath 410.25. So we're pretty prescriptive about how the bears start to gain control, along with pairing that with our exchange level strength from the market internals. Let's take a quick look at the NASDAQ market profile. I would echo a lot of the same sentiment as the S&P. So obviously, you can see that your value areas are here, here, and here. Same thing can happen on Friday with the overhead supply coming from this point of control migrating in the upper range of the session. Do we have some single prints to be paying attention to in I period? Yes, we do. Falling underneath 17,382. 17,382, 380. We're kind of splitting hairs. 2 points in the NASDAQ is not much. 17,380. If we slip that, I think you start to see a stronger pullback. We do have a poor low. I don't think we pointed that out on the ES, but we do have a poor low over here as well on the ES back-to-back A and B period. So that poor low could be in use of some repair or in need of some repair. And again, on the NASDAQ, we are looking for a gap to close around that area as well. So does a pullback make sense first to me? All of the supporting evidence would say yes, but we are not throwing in the towel. We are not forming a big bearish opinion. We're looking for a pullback, get involved on higher lows when and if the buyers start to step back up, and then we are back in an overall uptrend. And finally, for our broad market, we have IWM Russell 2000 and the small caps, the problem child, if you will. But I actually like the weekly chart here. If we're talking about candle structure and location, green hammer candle, where the buyers clearly stepped up in that lower wick, and because of the green nature of the candle body, we know that we moved through the opening print for some range expansion, and we were able to close near the highs of the weekly range. A little bit of an upper wick, but nothing to really write home about, especially in relationship to the size of the lower wick. So structurally, I would say that the buyers are in control. If we think about location on the bar-to-bar count, we do have a lower low as well as a lower high, so not so great. We get a split count here on the IWM weekly. However, let's add a little bit of context. We do have a weekly 200 SMA over here. We generally take moving averages with a little bit of a grain of salt. You can see that we just chop through it here. So not an end-all be-all indication, but it is slightly more supportive of like buyers trying to step up and treat this as a mild pullback as of right now, which really brings me to my next point, is that this as a pullback is looking very constructive. We went wall to wall on the weekly or even monthly balance range, depending on how you want to count it, right? We went from the bottom straight to the top. So is it reasonable that we could have gotten a pullback here? The answer is absolutely. And as long as this can find a weekly high or low somewhere around this area, we know that this was particularly more attractive around 190. Obviously, we've closed back above it, but we did test underneath. But as long as we can hold this as a higher low, any reattempts to the top of the range, I think you've knocked too many times on the top of this door, especially now after a constructive higher low. Can we ultimately get the breakout more firmly up and over 200? That would certainly be more constructive on the bull side for the broad market as a whole. So if this baton is going to get passed between like an AI mania rally that kicks off on the Friday session of last week, maybe it carries forward for this upcoming week's worth of trade, then maybe it starts cooling off and going sideways for consolidation, and the IWM in the meantime has found itself at the top of the range, and then we break out, right? I'm trying to just build the picture of one possible situation as to how this market could continue throughout 2024 if small caps start outperforming over 200, which on the weekly chart, again, mild pullback, great first step. If this is going to be the path that ultimately plays out, I think we're kind of in business here. So let's take a couple of measured looks here with our Fibonacci's from here to here. I mean, 38.2, right on the money with that 200 SMA. Is that constructive? The answer is absolutely. Is this healthy bull flag consolidation? The answer is absolutely. If we can clear the top of the monthly balance range, again, up and over 200 more constructively, let's even drop it down a little bit lower. There's 200. Resistance, resistance, resistance. Poked through it. Now we're back down underneath. If we can pop back up through that again, what else is there to say other than this is a constructive higher low on the weekly time frame? Let's bring out the anchored view apps on the IWM. And the one issue we have to do here, it's not really an issue, but let's bring this out to a 5-year chart so we can get the proper pre-sickness high, sickness low. Speaking of the sickness, I have a vengeance with that thing now that it's sort of taken me for a second rodeo here over the last week. So we're feeling much better now. But over the entirety of the anchored view app band. So again, is this constructive in the upward direction? To me, the answer has to be yes. This is a healthy pullback until proven otherwise here on the weekly time frame chart. Beautiful hammer structure right off the top of that view app band. Let's finish it up with our volume profile on the weekly. See what else we can learn. And, what is this? Right off the high volume node. Do we still have to contend with this at 200? Yes, but obviously that's the case structurally anyhow at the top of the balance. So finding support off of the highest volume node, maybe highest volume node in the midpoint of the range. Obviously this high volume node is at the lower end of the range. So this is making a lot of sense. Again, very constructive on the IWM weekly. I actually love this weekly chart to possibly start looking back in the upward direction. If we slip all of these levels, if we take out last week's low, yeah, we'll change our tone. There's not likely going to be a setup until we can actually breach some key daily levels. So let's take a look now. So expected move, as always, is up first. We can clearly see 196.72 as the upper bound, and the lower bound is down here at 188.13. So expected move is a little bit more neutral to me, suggesting an equal low and maybe equal highs to the shelf up here. One thing I do like about the upper bound, though, is that it would suggest there is possibly a break up and over this shelf at 193.50. And as I was just mentioning on the weekly time frame chart, we need to clear some hurdles before we're really feeling good about that weekly hammer. And the first hurdle is just this one right here. We don't want this to act as overhead supply anymore at 193.50. Now I have to give the bears the benefit of the doubt, because if we just go back to the basics, obviously we're in a daily downtrend here with highs, lower highs, and an opportunity for lower highs underneath 193.50. Now it is constructive seeing what happened with the gap down on Wednesday, seeing Thursday reverse and close back near the highs. Same thing on Friday with that range expansion, closing a green candle there. But again, you got to clear that. You've got to show me something a little bit more constructive. constructive. There's your inverted head and shoulders on the daily. And now we're talking about a daily uptrend. And now we're talking about, yes, I can have more faith in the weekly trend reversal, or I should say weekly higher low holding with that hammer we just sort of explored. So this is kind of your key watch. Can we get the recapture here of 193.50 out of small caps? And if so, can we continue this push in the upward direction? Can we get the break up and over the neckline? That's obviously your next big hurdle where you clearly had prior support now acting as resistance and resistance here. We've broken down from this. So, it's not going to be an easy path forward, but that's one possible way that I see the IWM reversing and playing nicely with the overall bullish nature of the broad market. If this does not happen, if we cement ourselves a lower high here, I'd be very cautious about broad market participation on SPY pullbacks in particular. The QQQ kind of stays in its own lane, but as we've sort of described over the last, it's been like years at this point, the SPY is really caught in the middle between the IWM and the QQQ. So if the IWM really struggles here, if it cannot get up and over this hurdle at 193.50, just keep in mind that your pullbacks in the SPY might be a little bit shaky. You really need outperformance from the QQQ. So let's simplify it here. Just like we gave you a situation with the QQQ and the lower high, we'll simplify here with the IWM and the QQQ in tandem for the S&P. Here we go. If the QQQ is rocking and rolling in the upward direction, there is our triple Qs. If we're rocking and rolling, making new all-time highs, and the IWM is somewhat weak, then guess what? You could probably be a little bit, you could probably side with the buyers on your S&P 500. If the IWM is weak and it stays underneath this level right here, 193.50, so let's put a down arrow for your IWM, and the QQQ is now just lackluster, it pulls back, it doesn't really hold the top of the range at that 412 area, it goes back down towards 410, I probably would not be as aggressive in your S&P 500, right? That's how these two things sort of work in unison to inform decisions, and confidence, that's the main word there, confidence in the S&P 500. So key line in the sand for the IWM small caps, 193.50. I think that really holds the secret for the coming weeks worth of trade. Above, we're constructive. Below, not so much. Sort of, dialing back expectations for the S&P on any pullbacks. One thing that I could point out here as well on the daily time frame chart, let's just auto zoom that, there we are, to deal with a little bit of a better structural look. There we go. So your prior breakout point right here is acting as that support. So again, on the higher time frames like the weekly, we know that this is a weekly higher low pullback attempt, right? You're also getting confluence with your daily 50 SMA, and 50 SMAs, 200 SMAs, those are the Godfather SMAs. Those are the ones I care to pay attention to on the daily time frame or higher. Not so much on hourly time frames, 5 minutes, XYZs, but for the most part, this confluence right here, at least to me, would suggest that, all right, even if we don't break up and over 193.50, this neutrality with a QQQ weakness, not bullish for the S&P. This neutrality, QQQ strength, not the end of the world. Maybe we can be cautious bulls in the S&P. If this breaks down, that's where we have a larger issue for the broad market as a whole. If we're not holding that weekly low that we've attempted to cement as a weekly higher low in the small caps, that is an issue. Once again, that level is around 487.75. 487.75 is the key low from what we have over here. Let's bring out, just for the sake of being very thorough in our first examination back after a little bit of that hiatus for the reasons we've already touched on, this whole cluster is still underneath us. So, is it the end of the world that we're in a daily downtrend here? No, I think that this supports the idea, and we just saw this on the weekly chart as well, right? I think that this supports the idea that we can still find buyers and remain constructive on all of the longs who have really positioned during this pullback off of these lows. I think people are still doing okay if they have pre-existing long positions. As long as we're above, I would use this as your new line in the sand, 184. Is it possible that we get there? Yeah, it would take a violation of the expected move, but that wouldn't be unreasonable considering that we have this sort of multi-day just sideways activity here. We didn't really make much progress. So consolidation to then break, yeah, I think you could get to 184. It is a possibility. I'm just not convinced that I would be aggressive looking for that on the heels of what's starting to suggest. Again, let's just reel it back in. Let's bring it back to the chart structure itself. What happened on Thursday and Friday, and even the exhaustion gap down on Wednesday? Do we have stronger sellers? And again, giving them the benefit of the doubt in the downtrend, but gap down did not yield the gap and go. On Thursday, we tested lower, closed higher. Friday, tested lower, closed higher. So as of right now, evidence is stacking up that yes, it's a first test here. The big watch is at 193.50, but we know our key levels. We know the main discussion points here for the IWM and the Russell 2000. Let's take a quick look at the hourly chart just to see if we can learn anything different that we didn't already discuss. I think the answer is no. We are technically in an hourly uptrend here with higher lows as well as higher highs. So as long as this remains constructive, as long as there's a next hourly higher low in the sequence, I would start thinking about the test here here at 193.50. A key level that you could start watching would be around 191.25. You guys know the rules up here in the penthouse. It's round numbers only, so we have to add a 5 to the end of that over here. There we are. So something that does this, remaining constructive, at least for the test here. Now, if there's a sharp rejection off of that, and then we start to find like a lower low on the hourly, that's where we get stuck in this balance and we dial back expectations for the S&P. So a little bit of a long-winded answer here for the IWM, but I really think that this discussion point between watching the IWM, watching your QQQ will keep you on the right side of the trade in the S&P 500. I am a firm believer in that now more so than ever. It's really helped out over, I would say, like the last 2-3 months when I've started to be more explicit about watching that. Let's take a look at the market internals for the Russell side of things. Substantial volume outflows on Tuesday, Wednesday not so much, a little bit more constructive on that Friday session, but not near substantial volume inflows. Same commentary really here across the entirety of the exchange. We know that there's more weakness. We know we're in a daily downtrend, so it's not surprising to see that Friday, it was bullish, but it's on the heels of all bearish activity proceeding in the week. Even the Thursday reversal was not as impressive, I would argue, as compared to what we saw in the S&P and even the NASDAQ. We talked about in the S&P how it was really groundbreaking, that Thursday end-of-day rally. I mean, it helps. It helped, right? It kind of kept a higher low on the IWM, but there's a lot of work to be done here. This certainly is the laggard. If we're trying to be constructive, we already know that this is kind of what has to happen here. So watching that very explicitly for the small caps, we've reinforced that enough times. Let's wrap it up with our market profile on the Russell. We do have a double distribution. So I think perhaps this ties nicely in with the hourly higher low, right? If you do something like this, your Thursday high is very close to the closure of single prints out of the Russell. If I were watching for a higher low pullback, not on the hourly, but based on market profile, something around 1944 makes a lot of sense here out of this double distribution, right? You do not want to fall into the lower portion of what happened on that Friday session. So 1944 key watch out of your market in terms of the futures. If we just jump back on over here, 191.25, as we were just discussing. With all of that said, let's move along. Let's get granular and take a look at the weekly performance of our S&P sectors. We'll get to the SMH semis in just a second, but the XLK technically takes the top slot here as leading, up 4.26%, followed by communications, financials, consumer discretionary. At the bottom of the barrel, it's the XLU utilities, lighter weight risk off style sector, energy, lighter weight sector, real estate, lighter weight sector, XLP, consumer staples, right? Lighter weight sector, more D for defensive. So the point we're trying to get at is as we've broken out of this as a balance range up here in the S&P as a whole, is it being led by the proper sectors, the risk on heavier weight sectors? The answer is absolutely. I remember a couple of videos before we actually took the little hiatus there, we had said, hey, if the S&P breaks out of this distribution, this sideways activity, this balance up here via the lighter weight risk off sectors, that is a red flag. You do not trust that type of breakout, and that is not what we're currently getting. We're currently getting the support of the heavier weight risk on style sectors. One caveat I would say here, or a nuance I would point out, and hope that this is somewhat enlightening for you, is the XLV is a very important sector. Why? Because it's the second heaviest weighted sector by market cap, but as we know, it's technically more D for defensive. We really don't want it leading any market rallies because of its defensive nature, but because it's also the second heaviest weighted sector, we can't afford for it to be falling off of a cliff. You don't want to see down 3.22% out of the healthcare sector. It's just, that sector weighting is going to be too much damage for your S&P. So lo and behold, what did we get? 0.5% in the downward direction. That's about as picture-perfect performance as you could have asked for from the healthcare sector. That is just a thing of beauty based on this nuance we've just described. So with that said, let's take a look through some of these charts. The SMH up 8.02%. Mark Zuckerberg single-handedly breaking the semiconductor space in the upward direction. TSM earnings obviously helped out a little bit as well. But Zuckerberg with the 600,000 H100 equivalents of compute power. I mean, goodness, right? So by himself, new all-time high SMH. Thanks, Mark. In terms of trend and structure, bullish. I mean, we've closed new all-time high, solid green-bodied bar. Pullbacks could close the gap. Pullback could retest the previous highs here at 176.65. Nothing bearish to say about this chart. Mirror image, if you'd like, over here in the XLK, which is going to be a little bit more relevant for the S&P as a whole. Same concept. New all-time highs. Pullback to close the gap. Pullback to retest the structure. That prior all-time high is at 193. Nothing bearish to say about these charts. Again, risk on rotation, absolutely, with these two sectors leading the charge in the upward direction. Here's the XLC. Possibility is basically the same. Higher low over 74, higher low over 73.25. XLC is a risk on style sector. It's lighter weight than the tech sector and the SMH, obviously, of course, but still nonetheless would provide more of a bullish sort of confident stance for the S&P posture-wise. Let's move along and talk about financials, because this is where we can dive under the hood a little bit and at least explore the possibility of a baton pass, if you will. Let's say that the SMH, let's say that the Magnificent Seven do pull back early on in the coming weeks worth of trade. What do we have here out of financials? Financials are the third heaviest weighted sector after the XLV healthcare sector, and they are a risk-on style sector. So we do want to see financials outperforming with the market to be more of a risk-on style move. Look at the gap down and sort of hold there on the 3 days, Tuesday, Wednesday, Thursday, and Friday, right back into the balance. So it begs the question, if stronger sellers were truly active in financials, why were they unable to turn this into overhead supply and continue to weigh on price in the downward direction? It just simply did not happen, and any breakouts here should be construed as bullish. If the tech sector or the tech cohort really pulls back, you could see the baton being passed over to the financial sector, and that would continue the strength for the S&P 500. So watching financials very closely if there's a rotation early on in the coming weeks worth of trade. Next up, XLY, consumer discretionary. This is almost, it's the same concept in terms of the baton being passed. Tesla is obviously the biggest drag on this one. We'll talk about Tessie and Mr. Musk's boring company in just a little while, but look at your double bottom. Again, if there is going to be a baton passing, a breakout over this neckline zone here between 176.50 and 177.80 yields prices back up towards 182. That keeps your S&P 500 afloat. That would be a bullish rotation, right? So watching that very closely. So far, so good with the double bottom holding that upward sloping 50 SMA. Here's the XLI for industrials, lighter weight sectors, about 8%. Definitely not as risk on as the tech cohort, but bull flag. I mean, weekly bull flag for sure. Back up towards these equal highs, breaks over 112.40, constructive to go back towards the all-time highs. I would only be concerned about this one if there's a slip underneath 109, not just because it's the daily 50 SMA, but because we technically had thin structure over here. And if I zoom in on this a little bit further, I know it's a little bit skewed left, but you get the idea. There's your inverted hammer on the Wednesday session. Technically, gap fill reversal closed weak. Sellers had the upper hand. This was overhead supply. This is thin structure for a retest of the breakout point here at 109. Did that take place? Did stronger sellers step up? No, we're back in the range, and now we're threatening a break over the top of the range. So again, the only place where I would be more concerned about sellers getting active in industrials, and again, this is 8%, so take it for what you will, is underneath 109, something that looks like that. Currently not the case, not a relevant threat. XLU, what's going on with utilities? Falling off of a cliff here. There was some relative outperformance, and we were slightly concerned about this as the SPY daily balance was beginning to unfold and show its hand, and now that this is lower, not as concerned, right? I can go back and point to that video. I'll actually put a screenshot up now. You can go back and listen. Here's the XLE as a proxy for crude. A little bit concerning here. Again, global demand. We're talking about global demand, global recession. Why is energy getting beat up so bad? Even with some of the catalysts, like not that they're good catalysts, but think about what's happening in the Middle East, think about the tensions and the shipping lanes, right? If there are going to be increased input costs in terms of taking different routes that are going to further the cost of, transportation, if there's going to be extra security measures, you get it. It's an inflationary pressure. Energy is certainly lower. So again, global demand, even amid positive in terms of price direction catalysts, not really making sense. And we'll dive into the Fed's Beige Book sort of analysis as we get into the economic data. Things slowing down a little bit, yes, but if the AI mania is going to continue to play the song and there's going to be a chair left for everybody, this just isn't going to matter. So you're not going to short the S&P based on this indication here, but it is one minor data point in all of the data points that we consider that you might add into your context when you're thinking about things more globally. Anyways, we're continuing along. Here's real estate. Rates have obviously moved back in the upward direction. There's still an opportunity for a lower high. I would not be concerned about real estate unless we're underneath 3660. That's really the core of this balance from back here. And based on what's happening in the TNX, I don't really forecast this as being a preliminary threat. Real estate's also such a lightweight sector for the S&P that it's not going to make or break this week. Here's the XLP consumer staples, D for defensive balance range, not breaking out, not participating in the upside. Again, good. Even if the S&P is going to go sideways or pull back a little bit and this outperforms, it'll prevent an outright collapse. So we're all good in terms of the way that this rotation is taking place. Materials, lightest weight sector of them all. Little 3-day balance. Sure, 100% retracement, a little bit more meaningful there. Is this chart a make or break for the S&P? I just have to honestly answer that question with a no. If we do recapture and move higher, it's going to help, but it's not going to, again, it's not going to move the needle. It's really not going to move the needle in the S&P. XLV, last but but certainly not least, again, we were talking about a mild pullback being the best thing we could have asked for here out of healthcare, and that's exactly what has unfolded. Little mild pullback, certainly an opportunity for a higher low. Again, just like what we saw in the XLI, we had thin structure to potentially retrace back down underneath these lows. As a matter of fact, let's take this one on down to the hourly just to get really nuanced, right? There is your break. There's the gap down underneath. There's your foray to the downside in that lower wick, and the sellers could not accelerate. So second heaviest weighted sector not breaking down through the thin structure does strike me as bullish. The fact that it's not rallying and really producing the bulk of the gains in the S&P, also bullish, because as we know, we don't want defensive sectors leading. With that said, let's take a look at the ratio grid. So here it is. If you don't know how to set this one up, check out the video tutorial in the top right-hand corner. I think that these charts really speak for themselves. XLK relative strength, this is a risk on indication. XLV rolling over is a risk on indication because we don't want defensives outperforming, right? So this is a good looking chart over here. Financials, if the baton is being passed, a beautiful hold. I mean, just you can't make this stuff up, right? You literally have an upward sloping 50 SMA coming here to kiss us. If financials start to outperform, thing of beauty here, higher low. On something like a weekly chart, for sure, you're definitely getting a lower low from here to here, but you're coming from the highest high. So still giving the buyers the benefit of the doubt for that reason. XLY wants to outperform. If we can snap that double bottom neckline, I think that this has a chance to do something like this, but still it would be better if this were outperforming more substantially. This is really the one that gets the golden star for the day. In terms of the risk off sectors, are they outperforming? No, and no. So no concerns from that point of view. Let's take a look at some specialized ratios and get granular here. XLK SHY, moving too fast here. You can see that we've got a big uptick. That is a risk on signal. If we take a look at XLK XLU, big uptick, new higher high. That is a risk on signal. Let's take a look at the XLY XLP. There we go. This is apples to apples. And as we know, if the double bottom neckline can break out, this, of course, would be a beautiful hold over the top of the previous balance. Remember that it was quite some time that we struggled in the sideways activity. I would love to see this hold as a higher low. Does the market always give us what we want? It'd be nice if it did, but it may not. So just watching this one closely as your most apples to apples comparison, XLY over that XLP. So far, so good. Still a risk on indication, still looking for that higher low, but let's get in gear back up towards that equal high, shall we? Let's move along and let's take a look at the Dixie. What's going on with our dollar? Sort of pegged in the midpoint of this as an overall balance range. And if we take a look behind what's kind of, I don't know that necessarily it's driving it directly, but gold, it made this big push. And, you know, myself included, everybody was like, whoa, what's going on with the cup and handle? Actually, this is like a yearly cup and handle. Let's zoom this thing way out because it's just, it's too good to not look at again. There it is. Look at that cup and handle out of gold, right? So a big break of the handle and just zero follow through. And as a matter of fact, that's actually a good thing. We didn't want gold outperforming to such a substantial margin because it raises questions like, why, if the market's in a bullish sequence right now, are people flocking to gold, which historically is like a safe haven asset? So the way that this all ties back is if we take a look at silver, let's go on over to silver. Silver tends to act as a leader to gold, or at least it has in its most recent cycles. Silver's at a flush point, coming in after multiple lower highs, flat equal lows. If 2250 is lost, I would imagine gold also moves lower, and that could keep your dollar kind of more sideways in the midpoint of this range. And in theory, that means that, sure, we're getting a breakout here, but as soon as the AI music sort of stops, you know, this is not constructive. This is not constructive for a big break or continuation in the equities market down below. Ideally, this would find a lower high and rotate lower. So if that's the case, which again, the metals would not suggest that that is the case, but if we find a lower high here, great. The AI music can stop and the dollar will sort of play nicely in terms of reducing headwinds. But if the AI music stops and the dollar breaks out, which is kind of what metals are suggesting, then probably more sideways, more consolidation, a retest. Let's digest some of the breakout that we saw on the Friday session. So watching that closely here with our dollar. If we're purely just looking at technical analysis of the dollar, inverted hammers, you know, sort of rejecting the midpoint here. Yeah, a little bit of a pullback, but you're still just thinking about consolidation, then a break. And once again, this break here is what we're concerned with as a small red flag for the S&P. Let's continue along and take a look at interest rates because these are ticking in the upward direction. A little bit of lift after this big drive in the downward direction. You're actually seeing an interesting phenomenon here where I honestly don't think it's going to last. I don't think it's going to last. I think that Jerome Powell has put his higher for longer face on, and the data is still coming in to suggest that he might be right. But as long as there's a lower high on a weekly or monthly time frame chart underneath 43.33, we're good to go. And just to remind folks where that's coming from, it's this previous pivot top, right? If we can find a rejection underneath, I think you're back down into downtrend or even sideways here, and it's not going to act as much of a headwind anymore for the markets over here. We already knew that this was the most painful point for the 10-year. And we can even, let's drop it down. I'm just going to go back on over to this chart so we get the time frame correct. And let's take a look at the ZN, right? So these are notes via the futures. And if you're trading the futures, right, which is a little bit more tradable, or you could wrap your head around trading this a little bit more so than the TNX maybe, look at what we have here. You're certainly getting this as a lower high, but equal lows hammer candle on the Friday session. If we can get some pickup back up to an equal high, you're just consolidating here. And like, let's take it one step further. What would the equivalent be of a retest of 43.33, right? A pullback to this. What do we know kicked off the pattern in the first place? There's your inverted head and shoulders. We never really got a higher low retest of that neckline around the 108.3. So if this pullback were to unfold, again, I don't really think that the move higher in rates is going to stick substantially until we actually break down underneath some of these areas in something like your ZN. Let's take a look at the inverted ZT. This is the 2-year, just to get a sense for what's happening with the tracker, right? This big uptick here would suggest that, okay, maybe instead of this was like aggressive cut as soon as March, maybe we're starting to deal with a pause, and that actually is the case. Let's dive into some of the fundamentals now. So there we have it, folks. Instead of pricing in 6 rate cuts in 2024, the market is now pricing in 5 rate cuts. And this is concerning because, as we know, the whole reason for the rally off of the October lows was a multiple expansion rally. The earnings per share in the S&P was not forecasted to rise substantially until the midpoint halfway through 2024, if not into 2025. We knew that earnings were actually going to take a hit into Q4 2023 and be shaky in Q1 and 2 of 2024. So the fact that we're reducing the number of rate cuts that are expected, in theory, should put pressure on the idea of this multiple expansion rally. If we've expanded based on the idea of 6, well, we'll have to contract a little bit to reflect 5, unless the AI music is going to carry us home into new all-time highs and continue to produce new all-time highs. So regardless, the point being here is that no longer in the month of March are we expecting explicitly a rate cut. If we go on over to the compare tab, you can see after the economic data came out, really it was on the Thursday session, the unemployment claims, right? You can see the odds dramatically shifted lower for a cut and increased for a pause. So that is fairly interesting over here. Let's actually walk through that economic calendar because we're in a little bit of a twisted scenario where good news may actually yield bad reactions from our market. So first and foremost, here we go. Empire State Manufacturing Index on Tuesday was the worst read we've ever seen since the sickness lows over here. Look at how we just smashed through this. That is not a good sign in terms of economic productivity. So, okay, that's not really a good, piece of information. What about retail sales? Retail sales came in hotter than the expectations. You can see by 2 basis points in each category, core and non-core. And if we look at the breakdown of the report, you're actually not seeing anything very impressive here. So percent change December compared to November. We're looking at this column here on the left, right? The biggest drivers of retail spend were motor vehicle and parts dealers, right? If you look down the list, you can see clothing and clothing store accessories. And then down further, you're getting non-store retailers. To me, the biggest driver there is just going to be your Amazon, right? They don't have a store. You order all your stuff online. It also takes into consideration little kiosks, pop-up stands, XYZ. So this is interesting to me because this is the spend around the holiday timeframe. And if you look at what happened with electronics and appliance stores, not great, right? It actually contracted and was not indicative of any expansion, even in the prior, right? 1.8 to the downside here. So what does that mean? Well, your consumer discretionary makes sense that it's lagging, right? And for the most part, by the way, just to clear up any confusion, the tech sector, other than Apple, basically, right? Microsoft, Amazon, those guys make, well, Amazon not so much because they sell goods, obviously, but let's just talk about Microsoft because it's the largest now market cap in the S&P 500. They don't make money by selling you, Surface laptops and Xboxes and all that stuff. They make money via their software services and the cloud, right? So it's roughly like this is a quarter of their revenue. So they're not really hurting because things are down over here. But Apple's fall from grace, yeah, this makes much more sense when we see, electronics and appliance stores down and Apple is like, getting replaced as the top dog in the S&P 500. There's nobody spending on these types of things. This is much more so consumer staple style spending. We need clothing. We need things from Amazon, Amazon Basics, right? All those sorts of things makes much more sense that the AI mania rally is kind of what's driving things. Other than that, the retail spend is not in the right place. Let's take a look at what's going on back on the calendar here. As we continue through the week, unemployment claims was the largest driver to adjust the expectations for the Fed, right? So we're just sort of shaping the picture here from a fundamental perspective. We came in well underneath the expectations, 187,000, which is just not even close to what's required for a large, deep, dark, dirty recession, right? You really need to see, at least recently, we would start becoming concerned on reads over 250. But if we look historically at what's happened here, I mean, red marks a recession, of course, just to be clear on what everything is here. You need to see this large acceleration, 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 so on and so forth, right? We're actually decelerating. Things are getting better on the jobless claims front. And that's like, that's really important to note because this is what the data suggests. And you might see headlines that say things like this: Wayfair, Google, Amazon, Duolingo cut hundreds of jobs, right? Tech layoffs are around the corner for 2024. And while that may be true that these things are around the corner, it has not happened yet. So we're not shorting the market based on these headlines. It just does not make sense. It's not being reflected in the data that we actually care about. One thing to point out as a little bit of a caveat here, and you're not seeing it reflected because we have turned off our yellow star events, but let's apply that filter. I really do think Meet Kevin does a great job with his fundamental research, and he did a really in-depth report on the Beige Book. And this is not my field of expertise, so I'm going to lean on him here and say his analysis of the Beige Book was very thorough, and he's read, highlighted, understood all of them for quite some time now, years of backlogs he has. And he made a point to say that things are not looking great based on the Beige Books that were released from the multiple feds, across the states here. And again, is this possibly a precursor that economic conditions are contracting? Again, maybe you pair this with something like Empire State Manufacturing down, this much on the Tuesday session. These are like anecdotal things that start to say like, okay, there might be some cracks in the armor, but I wouldn't freak out about things like this. Could there be some slowdown? Yes. Are we going to fall into a deep, dark, dirty recession? Not unless this number starts coming in aggressively over 250. So if those layoffs are true, if the Fed's Beige Book is going to be true, if Meet Kevin's analysis is going to be true, and this is going to act as a leading indicator of pain to come around the corner, then we'll be able to see that on the week over week read of the unemployment claims. Like, let's just go back to this chart for a second here. This does not happen, like the recession is usually declared in hindsight, by the way, that's first and foremost, but this is like a process that takes multiple weeks. This is not something where like 1 week and all of a sudden the market's at zero. So if jobless claims on the week over week basis start increasing and ticking over 250, that would be the largest tell. I wouldn't get too wrapped up in the anecdotal evidence of what you see in the headlines, as well as maybe the Beige Book. So Meet Kevin, I appreciate the analysis on that stuff. It was very insightful for myself, but let's leave the technicals to someone who doesn't use Heikin-Ashi charts, and we'll leave it at that. I do appreciate all of his work on the fundamental side, though. Anyways, the last thing to point out on the calendar over here, right? Last thing to point out, consumer sentiment and inflation expectations, another big driver as to why the Fed is likely done with hikes. And now we can just put the tough mask on and say higher for longer. If we take a look at what's happening over here, people had the expectations not very long ago that inflation was going to remain unhinged at 4.5%. I mean, that was literally just a couple of surveys ago. 4.5% inflation. Look at where it is now, 2.9. 2.9. Long run inflation, 2.8. Right? So this has stabilized. The public's perception of inflation has stabilized. And again, this is a bullish thing to see this coming down. Inflation expectations are easing. And they're also, in terms of, let's just go back on over to the calendar here so I can show you the consumer sentiment. Consumer sentiment is one of the highest that it's been in recent times, right? Since the lows of, way back here, October of 2022. So if we're just shaping the fundamental narrative through all of these different data points, and I know we're doing a deep dive check-in on the fundamentals, that's because of our little hiatus here. We've been sort of out of commission. The story is that in my eyes, the story is that the soft landing is still very much so achievable. Unless the unemployment claims on a week over week basis suddenly start upticking up and over 250, I think if there's any takeaway from all of the things we've just explored here, if there's an uptick on this, yeah, we'll start, telling you, hey, watch out for this, watch out for this. But as long as these numbers come in as they are, as long as consumer sentiment is now the strongest it's been since the October lows of 2022, as long as inflation expectations have fallen dramatically from over 4% to under 3%, I mean, come on, you're not going to get a deep and dark, dirty recession when things are looking like this as they currently are. And again, the reason all of this is important is because it all speaks to the expectations of what the Fed is going to do, and we know that we've seen a multiple expansion rally. Here is the earnings from FactSet. This is the report. It's going to continue to start coming out and being updated as we get more of the heavy hitters reporting. But you can see, here's that pain. In Q4 of 2023, we're not expecting anything glorious. It should not be a good ride. Early stage recovery, Q1, Q4, or Q2 of 2024. And then things start to look better into the end of 2024. So if the Fed does not cut rates, this is the bottom line here. All of this fundamental analysis all comes down to this. If the Fed is not going to cut rates 5 times in 2024, and there is no expansion of earnings, the actual earnings, EPS, earnings per share, then the market does not have any justification at the current valuation. It should come down. That is the fundamental argument, right? We're not saying that it's the technical argument. The technical argument looks like it's higher right now, but this is the fundamental viewpoint that I could see someone building, and that is that in a nutshell. This coming week in terms of earnings, before we get back on over to the technicals and what feels like home, here is the calendar. Some heavy hitters, you know, the deal is it's always on when Netflix starts to report, then we're getting Tesla, and then as we move into the following week, we'll get all the Microsofts, the Googles, the whole 9 yards in terms of the Magnificent Seven. So there it is. Take a snapshot, and now let's get back to the technicals. Risk appetite via TLT ratio to the S&P is moving in the downward direction, meaning that risk appetite is strong for equities down below. And I think that there's a very specific reasoning for this. If we take a look at bonds in relationship to themselves, you can see that they're moving in the upward direction. So this might be like, hey, that TLT relationship is sort of broken. This is risk off, Matt. Red flag should be going off in your head. And I don't think that that's the case just yet because of the analysis we did over on the TNX and the ZN futures for the 10-year, right? And the reason behind this is, and I can speak to this firsthand, I have people in my life who have reached out and said, should I buy, long dated treasuries now? Should I get back into these things now that rates have ticked slightly higher? The answer is well, first of all, I'm not a financial advisor, so I can't tell you. But secondly, the answer is in the charts, this reflection that we're seeing here, and here, I think it's a big second wave of people who missed the top in the highest part of interest rates, flooding into a number of different products before rates possibly take another turn in the downward direction via Fed rate cuts or just via the natural movement of what's happening here in the market. And the reasoning behind that is if we take a look at some more evidence, and again, this is why a multifaceted approach is really the proper approach. This is not suggestive of a credit event. This is not suggestive of a credit event. Sure, are they moving slightly sideways? Are the downtrends not as aggressive as what we saw here and here? Absolutely. Of course, I would concede that point. But these are not moving higher. These are not moving higher. So in terms of like big credit event, oh my God, buckle up, the market's going to go to hell in a handbasket. Absolutely not. And again, I think that the reasoning for the bonds in relationship to themselves moving in the upward direction is you're getting that final tailwind of people who are like, oh, let's just grab them one last time before things ultimately roll over, which as we know is what the Fed tracker tool is ultimately pricing in. There is a divergence here which supports the idea which we aligned with in the S&P itself that would suggest a pullback should happen first, right? Here's your new all-time high in the SPX. Here's your HYG. Divergent, 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 divergent. So pullback first, yeah, this would actually agree with that thesis, but it's not the end of the world. This is not like, oh my God, new lower low underneath here. This is like, no, pullback, consolidation. Now let's get back in sync if that pullback can stick in the S&P 500. So that's what I would be watching for here in your HYG high yield. Let's take a look at the Bitcoin chart. Bitcoin was the biggest disappointment of the early stages of 2024 I've ever seen. Everybody got all fired up just for nothing. Now, I haven't checked in on Ethereum. I haven't looked at the chart, so I'm just going to stay, ignorance is bliss. Isn't that what they say? Let's move along and let's take a look at the breadth charts. New highs versus lows. So as we're making a new all-time high in the S&P, this is actually just hovering sideways. I would expect that this slowly starts to catch up in the upward direction over time as long as this consolidation can hold. We'll take a look at the RSP in just a second to see the equal weight S&P, but so far, breadth does not really strike me as concerning. We know that in the early stages of a recovery, things can actually remain somewhat negative, or not negative, but just not impressive blockbuster reads to the upside. Here's the SPX A200R, minor rollover. Again, red flags? No, not at all. I mean, we're over the 50% mark. There's room to run in the upward direction without becoming overbought. I think that this is still a solid looking chart supporting the idea that, yeah, higher is still very healthy at this point in time. Let's take a look at the SPX A50R. A little bit overbought. And now that we've pulled back aggressively and we're moving back in the upward direction, I wouldn't look at this divergence and say like, oh my goodness, the market needs to crash. I would look at this divergence and say, okay, now there's more of an opportunity for more companies across the S&P to recapture their 50 estimate, get this up here, and now we're just right back in towards like the upper bound of what's possible in the SPX A50R. Don't forget that this is basically an oscillator. It can't really exceed 100% of the companies in the S&P 500. So is it reasonable that you just consolidate up here? Absolutely. And a new all-time high, not really concerning. This is much more concerning when we're in the midpoints of ranges and we're looking for confluence. Is the recovery real XYZ? Not the case currently. So all good out of this one, more of an opportunity for companies to start recapturing. And again, speaking to breadth improving, continuing to improve, and not just returns being driven by the Magnificent Seven. Let's jump on over to those equal weights because this is where we got to talk. Obviously, we are not at an all-time high in the equal weight RSP. Let's take a look at the monthly chart. You can see that we're off of that all-time high, but we are over the top of the balance area still. Let's drop it back down to that yearly. And I just want to point out that this is, early on in the week, if we see that rotation we were discussing between financials and consumer discretionary, this will likely yield higher for the RSP. If we don't see any rotation and the market is not going to hold up constructively here, right? So let's say that there's a pullback and the RSP makes a move like this. That would be a little bit more of a red flag. It would just sort of suggest, and you would see this in the sectors themselves anyways, it would just suggest that you're not seeing the baton being passed over to some of the lighter weight representation in the S&P. But just because it's lighter weight, right, there's more of them that are lighter weight as opposed to the top concentrations. You get the idea. Let's move along. Let's take a look at the QQQE. This is actually playing much more nicely with the NASDAQ. It also is not at a new all-time high. You can see that that would be over here, but it is constructive up and over this in here. 3-bar play on the monthly time frame chart developing. Let's just drop it back down to the daily. So far, it did break out. It did make an equal high, if not very, very nuanced higher high on that Friday session. So this is aligning with, yes, being trustworthy in the NASDAQ itself. S&P, a little bit more well-rounded, as we know. Let's jump on into the Dow and see if this is working nicely. And the answer is, yeah, it's still a little bit skeptical. Transports are saying not yet. I mean, there's just obviously a relative divergence between these two areas right here. So it doesn't mean, again, none of the indications that we've covered so far in supporting evidence categories mean go out and short the S&P 500. They would just maybe suggest that, okay, in terms of looking for that pullback first, which we've really outlined since the beginning of the S&P analysis anyways, on that sort of internals dashboard, right? That's probably the outcome we're looking for based on some of these minor divergences we've seen, namely HYG, Dow Jones here as well, RSP also looking a little bit weak on a relative basis. What about the volatility market? You can see that, a little bit of an uptick here, but not much, just rejecting off of that 15, still suppressed down towards these lows. We know that the precursor is the VVIX, volatility falling back apart, even after some of those gap downs, namely that Wednesday gap down, sent things a little bit higher, and we were right back down towards a very comfortable spot. Remember, 75 is complacency zone. So it's actually kind of funny how that worked with this big sort of uptick over here, right on cue off that 75, but now moving back lower again. No issues from a volatility point of view and still in deep contangos, with our volatility futures. These have been updated to represent, I think I have. Let's actually double check. Let's double check. Real-time edit here for our VIX contangos. We want the G minus. We want G minus H. Are we on G minus H? Yes, we are. G minus H. All good to go up here. I want to make sure I was showing you the right thing. That is how genuine I am. We are going to show you the right thing. If it was wrong, I wouldn't be able to sleep at night. Anyways, jokes aside, contango, no issues from a vol perspective. Same thing here, 9 versus 30 day, and the 1 day just compressing down below as well. Volatility, not much of an issue. We'll throw in the skew just because it's a full comprehensive look in the first video back after a short hiatus. Just 2 weeks. I'm amazed at the number of people who reached out in support, concerned about my health, my well-being. You guys are amazing. I mean, you really are. It's an amazing community. I am okay. I've recovered from the sickness, and we're good to go from here on out. But truly, from the bottom of my heart, thank you to everybody who reached out, left a positive note via email, commenting on old videos, the whole 9 yards. You guys don't go unnoticed. Very, very much so appreciated. But anyways, back to the skew here. Tick in the upward direction, but nothing that is substantial. Still in this box as a whole. Remember that when the skew is elevated, it just means that a lot of people do not trust the rally. And that's usually fuel for the rally to continue in the upward direction, if I'm being honest. The most important indication of the skew is when it's low and everybody's thrown in the towel and is like, oh my God, everything's good to go. That's generally like, okay, there's your bottom, right? So anyhow, all good out of volatility. Let's take a look at our core list of companies. So if you've made it to this point in the video, since we are ultimately on the recovery arc, do me a favor, like, comment, subscribe, all that good stuff, but share the video to let people know that we're back in the saddle and we didn't fall off the face of this earth. Let's kick things off here. Our core list of companies is Apple on a daily time frame chart. The pattern in force, of course, is this as a double bottom. As long as we're up and over this neckline at 187, I would have to side more so with our buyers. But even more importantly than that, the bottom of the original gap down from over here at 188.45 was also the lows of this consolidation range. If this was going to act as overhead supply and weigh on Apple in the downward direction, we should have gotten a lower high around that area. It simply was not the case. Now, don't get me wrong, the Bank of America 20% upgrade on Thursday morning did certainly help, and it sort of changed the tone here on Apple's daily time frame chart. Now we have lows, equal lows, highs, and higher highs. The name of the game is participating on any higher lows and then looking for continuation back in the upward direction. So probably wouldn't be a new money buyer on the heels of a gap up and continuation rally from Friday, but higher lows definitely on the table, 188.45 and 187 as your levels underneath. If we slip 187, I think that the name of the game is quite obvious. It's all about the gap below. 185.86 closes down at 182.93. Let's move along and take a look at Microsoft. New all-time highs. Yes, sir. Not much to say. Blue sky territory is up and overhead in terms of pattern that's in force. This range has certainly broken out. There's really a lot of these charts that are moving towards all-time highs. The name of the game game is just participating on any pullbacks. There's no large indications yet, at least, where we're looking for trend reversals. Here's the hourly chart. You can just see that we had buyers step up for the gap fill reversal, closed at new all-time highs. So in terms of in-depth analysis, not much to do here on something like your Microsoft. Higher low pullbacks are the name of the game. You can see the levels. We have 393.75, 389.25, and I would say that your line in the sand probably just wants to be right here at 380, 380. Let's move along and talk about Google. Google is almost at all-time highs, not quite there yet, and I think that the retest level here is much more well-defined at 143.50. Any higher lows, then looking for higher highs and basically trend continuation ultimately towards that 148.50. All-time high is technically sitting up there at 151.55. Let's take a look at the hourly time frame chart because I do want to talk about how the sellers failed on the Wednesday session, right? There was this big foray out of this, or range exploration, range expansion, if you will. And, it didn't really yield a sticking of lower prices, and instead you can see the break through these equal highs 1, 2, and 3 on the Friday gap and go. So for the most part, I think buyers remain in control. This is evidence that your sellers are weak currently and you want to participate in upside trades, not so much downside reversals. Next up is Amazon. I think that we can have mostly the same opinion here, but we haven't gotten the breakout yet. This is a contender for an equal high breakout. As a matter of fact, let's go to the daily chart first so we can see this. This is more of your pie in the sky inverted head and shoulders, right? Something that looks like this, and even on the hourly time frame chart, it's the exact same thing, but one notch down, if you will. So any higher lows at this point want to hold that neckline at 153.80. Any holds of that, pull back higher low, you're still getting an hourly higher low, trend is up. We're then watching for an equal high breakout, and on the daily chart, we saw that that also made sense, up and over 155.25. So Amazon longs, your target overhead 157.75. Do we have anything after that? 163.50. Goodness, that is quite the target overhead if we can get rocking and rolling in the upward direction. Totally reasonable. If we think about this as ultimately just a balance range, because it was very sideways, lower, higher, like this is kind of a balance, right? I mean, not for nothing, but we could start scratching at that 163.50 probably sooner rather than later. Let's take a look at NVIDIA, new all-time highs. You want to talk about the AI chip mania breakout, just a beautiful range break. This, I know I was absent from the channel, but you better bet your bottom dollar we were talking about, or I was at least participating in breakouts up and over the top of this range. This was like, if there was ever a time to go long NVIDIA, there you go, there's that lingering sickness. If there was ever a time to go long NVIDIA, it was on the break of this multi-month, almost year-long balance range over here, up and over that 505-ish area. So thing of beauty, what we have currently in front of us, just like your Microsoft trading towards all-time highs, trying to participate in upside as responsibly as possible, looking for pullbacks to get involved in. There's no stronger indications of any reversals here. There's no big hey, watch out, this is a red flag type of warning. Everything's gap fill reversal and, trading back up towards these all-time highs. So not much commentary to bring there on NVIDIA. Next up, let's take a look at Meta. What's going on with Zuckerberg's Fantasyland? Right at the all-time high. Equal high was produced. So in this one, because we're at that level, you can see the video is wearing on now. Higher, like this to me is like equal high breakouts are totally on the table as long as this AI sort of narrative continues with this massive investment. We're going to be the leaders in AI. I mean, there's probably some work to do to catch up to something like your Microsoft and the OpenAI partnership there. Nobody really knows. I haven't heard many releases from DeepMind over at Google recently. So like Meta, it could be the next contender, Llama 3, depending on how well the model is trained. I think that you could certainly see this play in the upward direction. So the name of the game, again, higher lows, participating in the upside, stronger shorts only involved in this one on lower highs underneath this level right here. I would still give it the benefit of the doubt for a daily higher low, even on a breakdown of these two equal highs beyond the gap close at 376.50. Let's continue along. Let's take a look at Tesla. Tesla is the problem child, and as we saw with consumer discretionary, it's certainly weighing on prices lower. And so this is the story, right? There's your balance range, attempted break coming from the higher high, no higher low, or equal low at that point. Again, coming from the highest high and just drilling straight down through this range, making equal lows to back here. So really, not looking great in terms of Tesla. And keep in mind, earnings are this week on Tesla. We didn't have anything else up, and we do have Netflix as the first contender. We'll get to that in just a second here. But the daily chart, there's no strong indication of a daily reversal. I mean, you have a little bit of a hammer candle down here, but you really have to recapture and produce some sort of like daily double bottom, daily something for me to be more confident in okay, it's time to rock and roll in Tesla back to the upside. If we take a look at the hourly chart, the first thing that I could these are the early seeds of a reversal, right? If this is going to be inverted head and shoulders, or it could even happen like this, like don't get so hung up on where the right shoulder is or where whatever is. Just understand that the illustration is low, lower low, and then we're looking for some sort of higher low. And that higher low could even happen like this. And I would still argue it's the same pattern, just with a different location, right? So something like that is also very reasonable. And again, these are the first seeds that maybe something more constructive can develop. But the largest area I would say Tesla has to be concerned with is right here. The one day where we gap down, it was an exhaustion gap down, big rally to the upside, and just sideways consolidation. Anybody who thought that was it out of Tesla is long in this consolidation as overhead trapped supply. First place that they can sell is 219.25. So any retests of that yield lower prices, we're not out of the woods. We're not out of the woods in Tesla. I think you have to recapture 219.25 before we could be more bullish out of Tesla as a whole. So that's the analysis on that one. To the downside, obviously slipping this, just continue to walk them down. We're obviously in a daily downtrend. That would be 195.65. Last but certainly not least is Netflix, and this is an earnings candidate as we saw on the calendar just a couple of moments ago. What day is that? 123. So that would be the Tuesday, right? Tuesday after the close. So ahead of Tuesday, maybe Monday, it's a contender as a trader, but here's the spiel, right? And we always go over this during earnings season. Whenever the company is reporting, you do not trade ahead of the earnings, right? That's generally my word of advice. Same week expirations, that is, right? So I wouldn't even really dabble around in Netflix. You're going to see the premium start to inflate in terms of implied volatility rising. And as soon as they report, implied volatility is going to crush. And even if you get the direction right, you could be left holding the bag. So I would say if you want to scalp it, maybe there's an early week scalp. Like we're talking Monday morning has to happen before the afternoon session, so before 1:30, and even at that, I probably wouldn't want to hold something through the lunch session, so call it 11:30 on Monday, before 11:30 on Monday. If we can snap this 486, watching for that quick sweep to the upside, here it is on the hourly chart, you can see that we have thin structure on the way down, so if you can break out through that neckline of the double bottom, if you will, 486, that's your constructive trade, but don't overstay your welcome ahead of earnings. Once earnings shakes out, you could probably start to step back into things later day on Wednesday, and then Thursday and Friday should be in the clear with the implied volatility crush sort of settling out in the options chain. So Netflix, primary idea is this. Other than that, we'll update you on Wednesday after earnings has already passed. So 3 trade ideas for you, and then you are on your way for the weekend. We are back in the saddle. It feels good to be back. Adobe is up first on the chopping block, and this ties in beautifully with the AI mania narrative, right? Because overall, Adobe is certainly working AI image generation into their product suite. And, you can see on Friday with the announcement and the beginning of AI Mania 2.0, it certainly participated in the upward direction. So over 600 is bullish for Adobe. And there's a couple of ways to trade this. You can clearly see that you're getting confidence with your daily 50 SMA. Daily pullback higher low, looking to move in the upward direction. The first target has to be this gap close here. So over 612, that's the high of Friday as well as the highs from over here. Gap closes at 618.50. That's easily something like a day trade can probably happen over the span of one trading session. And then as we continue to move forward, it's just looking at the all-time high. 634 is your possible target. Now, the second way is that the gap closes and then we get a higher low over the gap close and you trade into that 634 as well. Not interested in Adobe if we're trading sub 600 and back down underneath our 50 SMA. That would really be too much of a failed inverted head and shoulders breakout. Not interested in that case. Next up is going to be Oracle, not the Oracle of Omaha, but Oracle itself, the technology company. This is a sort of repeat trade idea, if you will. First time we were looking for the breakout over here. Obviously, we got it into the end of last week. So almost identical to Adobe, where we're going to say, hey, any higher low pullbacks that stay over the breakout point at $106.50, good to go. Looking at that as a higher low, lows, higher lows, higher lows, and looking for the gap to continue to close overhead. That gap closes at 113.60. If there is a larger pullback that goes underneath 106.50, I would not be as interested in Oracle. However, it is still in play over 105. That's your line in the sand. You don't want to fall back down underneath this as prior support, then acting as resistance, right? What was the main concept we talked about earlier? You like it when prior resistance, which is what happened here, turns into newfound support. Almost happened in these lower wicks there, but I wouldn't call it a full-blown retest, right? So the other outcome is just that you get continued movement in the upward direction. That's a little bit more difficult to trade because it's tougher to manage your risk against just a straight-up continuation play. You would have to look for some sort of constructive entry on the hourly chart. Here's one, actually, now that we're looking at the hourly chart. Here's a balance, right? Friday was really nothing more than just a balanced day up near these highs. If we open in that balance, great. Break higher low over the top of the range, bullish. Stop goes underneath, looking for continuation. Or if you're more of a swing trader and you're not just day trade scalping this thing higher as it makes that move, you You can put a stop underneath the balance, break out over the balance. So now your risk is ultimately this box right here, and your target is the gap close. I don't know about you, but certainly looks like at least a 2.5, maybe 3-to-1 risk reward ratio if you play your cards properly. That's Oracle. And then a very similar setup, but at a different price point, is CSCO. Cisco Systems. Big gap down from over here last earnings cycle. You can see this big long-standing balance range. Let's go to the daily chart. There we go, and we still have some of the gap to close. I would start to add in another level, though. Let's actually take this out here. This is not as important, and we're actually concerned with this level at 50.70. Let's go 50.70. Make some jokes in the chat now if you'd like about 69 because it's gone, and then we get 50.70. All right, so any retests of 50.70 or better are looking pretty solid for this. Break, retest, high or low, and continuing to close the gap overhead. So a lot of these ideas are mostly similar, that we're looking for some sort of way to manage our risk and participate in new budding uptrends that have formed. Cisco, not as involved in the AI mania. So I'd say in terms of ranking them from AI mania, you've got the list in order of my preference: Adobe, Oracle, and Cisco. In terms of setups, I think that the Adobe setup is probably the best and most constructive because there's a stronger opportunity for just upward lift without needing to pull back first. These charts, I would tend to think that this is a little bit of a hang up, right? It would be better to see these retests on your Oracle and Cisco. That's going to do it for today's episode of the Weekly Watchlist. As I was saying earlier, it is fantastic to be back in the saddle. I love looking at charts, man. I mean, seriously, I love looking at them. I love breaking them down, sort of digesting them and putting them into a reasonable framework to move forward throughout the week. Was I doing some of that independently while I was gone? Yeah, but to organize your thoughts into a full spread of a video, man, there's something to it where I've got this backlog. But anyways, enough about me, more about you. I hope you have a green trading week. As always, I will see you in the next one.